Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. Because imagine waking up, grabbing your coffee, checking your retirement account, and just realizing the exact safety net you built to protect you in a crisis is, well, it's what's pulling you under.
Yeah, that is a terrifying feeling. I mean, you look at your screen, you see this massive sea of red across the board, and your first instinct is usually just to, freeze. Or worse, panic sell everything at the exact wrong moment.
Exactly. And that is why we are here today. This deep dive is all about navigating the extreme market volatility that's been triggered by the March 2026 war and really the massive global energy shock we are watching unfold right now.
Right. It's a lot to process.
It really is. So we are building a step-by-step survival guide for your portfolio. If you are an everyday American investor, maybe you're sitting at the kitchen table trying to figure out if your hard-earned savings are safe, this analysis is specifically tailored for you. We are going to cut straight through the panic, look at what recent research is actually telling us, and figure out how to protect your money without, drowning in Wall Street jargon.
Because when you look at the actual data, the smartest money in the room isn't panicking right now. They aren't running for the hills. They are just adapting to the new reality.
Right. But to adapt to it, we kind of have to understand what it is. Okay,
Right.
let's unpack this. We can't fix the portfolio until we understand exactly what broke the market in the first place.
Yeah, you have to find the leak before you patch the boat.
Exactly. And when you look at the recent data, there is essentially a three-headed monster that is violently repricing the entire global market right now. Head number one is oil.
And that's the big one.
It is. According to recent analysis from the International Energy Agency, the IEA, they estimate we are looking at an 8 million barrel per day supply disruption right now.
Which is just a staggering amount of oil to suddenly vanish from the market.
Right. And as a result, Brent crude has been bouncing violently between $100 and $119.50 a barrel.
And just to put that into perspective for everyone, Goldman Sachs recently warned that if the disruption in the Strait of Hormuz lasts for just 2 months, we could see average oil prices hovering at $93 all the way into the fourth quarter of 2026.
Oh, wow. $93 all year? That
Yeah.
is huge, because that leads us directly to head number two of this monster, which is interest rates.
Right. The thing everyone's been watching.
Yeah, for months, everyone was assuming central banks were going to start aggressively cutting interest rates this year. But the sudden, massive spike in oil is reigniting major inflation fears.
Yeah. It completely flips the script on rate cuts.
It really does. And then you have head number three, which is the U.S. dollar. Investors are terrified right now, and when the globe gets terrified, they flee straight into the dollar as the ultimate safe haven.
What's fascinating here is how you have to look at how these three levers mechanically work together. I mean, this isn't just a two-day news clip. It's a severe macroeconomic shock.
Yeah.
When oil spikes to $119, it acts as a massive, invisible tax on the entire economy. It costs a company more to manufacture a product, it costs more to put it on a truck, and, it costs more to keep the lights on in the store.
Which means suddenly corporate profit margins are completely compressed.
Exactly. The profits just vanish.
Yeah, to me, this isn't just a pothole in the stock market. You hit a pothole, your car shakes, but you keep driving on the exact same road. This feels more like a massive climate shift. The actual gravity of the financial markets has changed.
That's a great way to put it.
Because when inflation spikes from that oil shock, central banks are just trapped. They can't cut interest rates to help the economy because lowering rates would just pour gasoline on the inflation fire.
Precisely. The fundamental weather of the market has changed, which means our very first step in this survival guide isn't figuring out what hot new tech stock to buy.
Right.
It's ensuring that you don't find yourself in a position where you are forced to sell anything right now.
Ah, okay, the old cash is king strategy. But I want to look at the mechanics of this because the numbers are just staggering. According to the data, in early March alone, $47.9 billion flowed into global money market funds.
Yep, the flight to safety.
Yeah, and $30.75 billion of that flowed specifically into U.S. money markets. At the exact same time, over $7 billion bled completely out of global equities.
The big players are fleeing to liquidity, there's no doubt about it.
So the strategy for the everyday investor seems to be take any cash you know you'll need for the next 6 to 12 months. So your living expenses, a down payment for a house, whatever, and put it into a liquidity bucket like cash, money market funds, or ultra short bonds.
Right. You are essentially building a structural defense mechanism. It's the absolute foundation of surviving a shock like this.
But wait, I have to push back here on behalf of everyone listening, because for the last few years, we've all been beaten over the head with the rule that holding cash during high inflation is terrible.
Sure.
Because inflation eats your purchasing power. If inflation is running at 4% and my cash is just sitting there making nothing, I'm mathematically losing money.
So isn't holding cash right now basically a guaranteed loss?
Well, in a total vacuum, yes, inflation erodes cash, but we are not in a vacuum right now. We are in a highly volatile, highly correlated market shock.
Okay, what does highly correlated mean for the listener?
It means stocks, long-term bonds, and even precious metals are all dropping at the exact same time. There's nowhere to hide. So in this specific rare environment, a cash cushion isn't just sitting there doing nothing. It is actually providing a massive invisible return.
Wait, really? How so? Walk me through the math on that.
Think about forced selling. Let's say you need $10,000 to fix your roof next month.
Okay.
If you didn't build a cash cushion and that money is tied up in a stock index fund that just dropped 20% because of this war, you have to sell your shares at a massive discount just to pay the roofer.
Oh, man. You have permanently locked in that 20% loss. You can never get it back. But if that $10,000 was sitting in a money market fund yielding a safe 4 or 5%, you just pay the roofer, and your stock portfolio is left perfectly intact to eventually recover.
Ah, I see. I always think of having cash right now like carrying a really heavy oxygen tank while you're swimming underwater.
I like that.
It certainly doesn't make you swim any faster. In fact, inflation makes it feel super heavy, but it keeps you alive when you absolutely need it. It prevents you from drowning at the absolute bottom of the market.
That is an excellent way to conceptualize it. It just buys you the time you need to let your other investments recover.
Okay, that makes perfect sense. So we've secured the cash. Now let's look at the traditional safety nets, because the old dusty rule book of investing always says, when there's a geopolitical crisis, you buy bonds. Bonds are safe.
Right, that's the classic playbook.
But when you look at the recent data, that logic isn't completely falling apart right now.
It is severely fractured. The classic assumption is that war equals rate cuts, and rate cuts make bond prices go up. But as we just discussed, central banks are entirely trapped by this oil shock.
Yeah, they can't move.
You have a slowing economy, yes, but you have surging energy inflation. There are even recent reports indicating that the Bank of Japan might actually keep the door open for further rate hikes because of how bad the supply shock is.
So buying long-term bonds right now is incredibly dangerous, and I want to make sure we explain exactly why, using a concept called duration. Sounds like Wall Street jargon, but mechanically it's really simple.
Please do, because a lot of people get tripped up on this.
Yeah, so think of bond duration like a journey. Buying a 10-year or 20-year bond right now is like committing to a 10-hour nonstop cross-country flight. Once those doors close, you are locked into that specific interest rate.
You're stuck on the plane.
Exactly. If inflation suddenly spikes and new bonds start paying out way more money, the old bond you are holding on that flight becomes practically worthless to other investors. If the turbulence gets violently bad, you can't just step off the plane.
And that is exactly what happened to a lot of investors recently. They bought long-term bonds thinking they were totally safe, but inflation effectively destroyed the value of those bonds.
Right, which is why buying a short-term bond, like a 3-month or 6-month treasury bill, is like taking a 10-minute city bus ride.
Much safer.
Yeah, you hop on, and if the bus engine starts smoking or if inflation spikes again, you just hop off at the very next block and catch a new bus that pays a better rate. Right now in this market, you want the bus ride.
This raises an important question, though, about what else goes into that defensive bucket. Because you absolutely want the bus ride. But the root of this entire 2026 crisis is a very specific toxic combination. High oil prices, surging inflation, and a strong U.S. dollar.
Right.
So in that scenario, the data suggests that everyday investors should look at combining those short-duration bus rides with what are called TIPS, Treasury Inflation-Protected Securities.
Okay, I've heard of TIPS, but how do they actually work mechanically? Why are they the ultimate shield right now?
They are brilliant because their core mechanics are tied directly to inflation data. With a normal bond, you lend the government $1,000, and they pay you a fixed interest rate.
Simple enough.
But with TPS, the actual principal value of the bond adjusts upward as inflation rises. So if inflation goes up 5%, your $1,000 bond actually becomes worth $1,050.
Oh, wow, that actual bond itself grows.
Exactly. And the interest they pay you is calculated on that new, higher amount. As inflation eats away at the rest of the economy, your TPS are actively growing to offset that exact damage.
That is incredible. It's literal financial armor.
Yeah.
Okay, so we've secured the cash cushion to prevent forced selling, and we've shortened our bond duration and added TPS to survive the inflation turbulence.
We're building a solid foundation.
We are. Now, if long-term bonds aren't a perfect shield anymore, the logical leap for a lot of folks is, well, the world is too crazy right now, I'm just going to sell all my stocks until the war is over. But taking a sledgehammer to your portfolio like that is usually a terrible idea.
Oh, it's how you miss the eventual recovery entirely. The research strongly warns against dropping your stock exposure to zero. The market will rebound long before the news headlines ever turn positive.
That's a great point.
Instead of selling everything, the strategy right now is quality compression. You don't necessarily need fewer stocks. You need dramatically better stocks.
Okay, define quality compression for me. What does that actually look like for the everyday investor?
It means moving your money out of highly speculative, debt-heavy companies and compressing it into rock-solid, cash-generating businesses. The market is actively punishing beaten-down growth companies right now.
Yeah, for sure.
Just look at the Russell 2000 index, which tracks smaller companies. It recently hit a yearly low. Meanwhile, the market is actively rewarding defensive, cash flow-rich sectors.
Like utilities. The data shows people are flooding into utilities right now. But wait, let me pause you there. Don't utility companies use massive amounts of energy to generate electricity? If oil and natural gas prices are skyrocketing, shouldn't utility companies be crashing because their costs are going through the roof?
That is a great question, and it brings up the single most important concept in stock picking right now, pricing power. Yes, a utility company's costs are going up, but utility companies are heavily regulated monopolies in their local areas.
Okay.
So when their costs go up, they are generally allowed to pass those costs directly onto the consumer by raising electricity rates. People will stop buying new iPhones, they will cancel their vacations, but they will not turn off their electricity.
Yeah, you have to keep the fridge running.
Exactly.
Yeah.
The utility company maintained its profit margin despite the inflation.
Ah. Here's where it gets really interesting. Think about those flashy, high-growth, unprofitable tech stocks. They are like a beautiful convertible sports car. They are amazing to drive on a sunny day when interest rates are zero and money is cheap.
Oh, absolutely.
But right now, we are driving through a blizzard of high interest rates and massive energy costs. That sports car is going to stall out and leave you freezing on the side of the road. What you need right now is the reliable, boring, slightly ugly minivan.
A minivan. I love it.
Yeah, you need companies with low debt, massive cash flows, and that pricing power you just mentioned.
Exactly. You need the minivan companies right now. And it's crucial to understand how incredibly emotional the market is. According to recent analysis, the volatility we are seeing in energy markets today resembles the wild, unpredictable swings usually only seen in cryptocurrency.
Crypto-level swings in the oil market. That is genuinely terrifying.
Which is why you shouldn't try to time the absolute bottom when you buy these minivan stocks. The analysis recommends dollar cost averaging.
Let's break that down because it's a total game changer for investor psychology. Dollar cost averaging just means slicing up your purchases. Instead of taking $10,000 and throwing it all into the market today, hoping today is the lowest price, you break it up. You buy $2,000 a month for the next 5 months.
Mechanically, it removes the pressure of being perfectly right.
Yes.
If you buy today and the market drops 10% next week because of bad news out of the Middle East, you don't panic. You actually feel relieved because you still have cash on the sidelines to buy your next chunk at an even cheaper price.
It totally neutralizes the panic. All right, so we've upgraded our stocks, fixed our bonds, and built our cash cushion. I want to look at the elephant in the room when it comes to war and inflation. What about the ultimate crisis shield? Shouldn't we all just be emptying our bank accounts and buying solid gold?
Well, it's the oldest reflex in the book. But looking at the data, the automatic assumption that gold fixes everything in a global conflict is actually failing this time around.
Wait, really? Failing?
Yeah. Investors largely bypassed gold in the early stages of this shock and rushed straight into the US dollar. The dollar is currently sitting near 2026 highs.
I have to admit, I am genuinely surprised that gold isn't the superhero of this story. But when you look at how strong the dollar is, it makes sense. And you see the damage it is doing overseas. Energy importing countries are getting absolutely crushed.
Brutal over there.
Japan's yen is hovering near 160 to the dollar. South Korea's won breached 1,500 for the first time since 2009. India is seeing massive capital outflows, shaking the rupee.
And that creates a massive blind spot for American investors.
Right. I mean, especially right now for an everyday American investor. We've got President Trump in the White House. Our domestic economic headlines are constantly swirling, so it's easy to get tunnel vision on just what's happening here at home.
It's very easy to ignore the rest of the world.
So what does this all mean for the listener? How should an American investor be thinking about international stocks given these massive global currency issues?
It requires extreme caution because you are facing a mathematical double whammy. Let's walk through the exact mechanics of it. Let's say you take $1,000 and you buy stock in a fantastic Japanese manufacturing company.
Okay, sounds good so far.
That company navigates the energy shock perfectly, and their stock price goes up 10% on the Tokyo Exchange. And you look at your portfolio and you feel great, right?
Yeah, I made a 10% profit. My $1,000 is now $1,100.
Not exactly, because that stock is priced in Japanese yen. If the yen simultaneously loses 15% of its value against the US dollar, which is the exact dynamic we are seeing right now, because of the energy shock, when you translate those yen profits back into your strong American dollars, the math flips. Your 10% stock gain is wiped out by a 15% currency loss. You actually lost 5% of your money. Your fantastic stock pick was completely erased by the currency collapse.
Man, that is brutal. You can be 100% right about the company and still lose money, so how do you fix that?
The data stresses the importance of currency-hedged investments. If you are going to hold international assets in places like Europe, Japan, or Korea, basically places that import a lot of energy, you need to look for ETFs or mutual funds that explicitly state they are currency hedged.
What does that actually mean under the hood?
Mechanically, these funds use financial contracts to lock in the exchange rate. They build a wall between the stock's performance and the currency's performance, so a strong dollar doesn't eat your profits.
That is such a critical mechanism to understand. Okay, so we've laid out a really comprehensive survival guide here. But I know that even the absolute best, most airtight plan can be totally ruined by a single bad habit. So what are the ultimate pitfalls? What are the traps destroying portfolios right now?
The first trap is underestimating the sheer level of fear in the financial system right now. According to recent data, the VIX, which operates as the stock market's primary fear gauge, spiked to 28.15 recently. That is the highest level we've seen since November of last year. When the fear gauge is flashing that hot, the absolute worst thing an investor can do is use leverage.
Let me stop right there, because leverage is incredibly dangerous. Using leverage simply means investing with borrowed money. You borrow money from your brokerage to buy more stock than you could normally afford, and it usually ends in what's called a margin call.
Which is the fastest way to blow up an account.
Exactly. Mechanically, a margin call happens when the stock you bought with borrowed money drops in value. Let's say you have $50, you borrow another $50 and buy $100 worth of stock.
Okay.
If that stock drops to $60, your broker suddenly panics. They demand you deposit more cash immediately to cover their loan. If you don't have the cash, and most everyday investors don't, the broker forcefully sells your stock at the absolute bottom.
They don't wait around.
Right. They take their $50 back, and you are left with $10. You are ruined.
Yes. In a calm market, leverage is a tool. In a market with a VIX at 28, it is financial suicide.
Using leverage right now is like driving 100 miles per hour on a sheet of black ice. You might know exactly where you want to go, your destination might be totally clear, but if you hit one tiny bump, one tiny slip of the wheel, your portfolio is completely totaled. You cannot recover from a margin call in a market this volatile.
That analogy is spot on. And the other fatal trap right now is headline chasing, because the headlines are incredibly contradictory. The geopolitical situation is shifting, hour by hour.
What do you mean by contradictory? Give me an example.
Well, take the oil situation. Yes, the IEA sees historical supply shocks due to the war in the Middle East.
Yeah.
That's a terrifying headline.
Sure.
But if you read the actual analysis, they also note that there is a planned release of 400 million barrels of strategic reserves globally. So mathematically, if you divide that 400 million barrels by the 8 million barrel daily deficit, it provides a massive buffer.
Oh, wow.
In fact, the math shows that global supply in 2026 could still actually exceed demand.
Wait, really? So despite the war and despite the panic, there could actually be a surplus of oil by the end of the year.
Yes, between strategic reserve releases and rerouted supply chains, the math could completely flip. And that is why headline chasing is deadly. If you read a scary headline today and make a massive bet that oil is going to $150 a barrel, and suddenly news breaks tomorrow about a diplomatic breakthrough or an accelerated reserve release, oil could drop $20 in a single afternoon.
And if you are chasing the trend, you are just wiped out.
Exactly. If we connect this to the bigger picture, it boils down to one simple reality. Right now, structure is far more important than attack.
Structure over attack. I like that.
You do not need to make your fortune in March of 2026. You just need to protect it. Because surviving capital is the absolute only capital that gets to participate in the next bull market. If you blow up your account trying to day trade a highly emotional, fundamentally broken market, you will have nothing left to invest when the sun finally comes out again.
That is the hard truth. You have to stay in the game to win the game. You don't win a marathon by sprinting through a minefield.
Exactly. As we wrap up this analysis,
Hmm.
I want to leave you with a slightly different angle to ponder as you look at your accounts this week.
Okay, what is it?
Extreme volatility, like the kind we are experiencing right now with this energy shock, isn't just a risk to be managed. It is actually a brutal, completely unforgiving stress test. And it reveals the true foundation of your financial life.
That's a really powerful way to look at it.
It is. When the dust finally settles on this 2026 geopolitical crisis, and will settle eventually, what is your portfolio going to look like? Will it be a completely different mangled shape, or will it have bent without breaking? Times like these are a profound moment to question not just what you invest in, but the fundamental mechanics of why you invest at all.
Are you investing for a quick thrill on a sports card? Or are you building a minivan that gets your family safely to retirement, even through a blizzard? That is the ultimate question we all have to answer. Don't forget to subscribe and hit that like button.